The trading week ending July 24th has officially come to a close, with both the Nasdaq and S&P 500 closing lower for the second week in a row. Some of this downward price action in stocks can be attributed to the increase in conflict between Iran and the US, which briefly spiked Brent crude oil prices to $103 per barrel. Obviously, this reintroduces inflation costs, concerns about corporate profitability, and also our ability to go and purchase goods and services as the prices of the pump start to go up again. However, the big news wasn't the war in Iran. Instead, it was investors' growing concern about AI spend, with both Tesla and Google reporting results this week and investors punishing both of them. So let's start first with Google. Google reported Q2 results and showed revenue grew 24% year over year to $119.8 billion, smashing analyst expectations of around $116.7 billion. On the earnings per share side, they totally destroyed expectations, $9.11 versus expectations of $2.90. I had to double and triple check that number because I couldn't believe myself. However, looking at adjusted earnings per share, that fell in line with expectations. Google delivered a beat to the bottom and top line, and yet the shares fell 7%. Why? Because investors grew increasingly concerned of Google's plans to increase CapEx by $10 billion to expand data centers. So their initial plan was $195 billion, and that has increased to $205 billion. Investors did not like this. That said, Google Cloud revenue jumped 82%, so these change in CapEx plans might be justified. Now, turning over to Tesla. Tesla reported a mixed bag of results, and the shares were punished, down 15% after hours. On the revenue side, they beat analyst expectations, growing 26% year over year to 28.8 billion, something like that, versus expectations of around 26 billion. On the earnings per share side, it was a complete disaster. Came in at 33 cents versus expectations of 53 cents. Why the big miss? Because they moved volume, but at a price, right? They slashed prices on cars and had a lot of promotional financing that collapsed operating margins from 4.1% a year ago to 1.4% this year. And like Google, they also reported a massive increase in CapEx, which brought free cash flow down to negative $1.1 billion, the first time they reported negative cash flow in over 2 years. So on the surface, this might look like a Google or a Tesla video, but I like to do second level analysis. It's not enough to see where the ball's at, you have to see where it's going. And to see where it's going, you have to follow the money. Both Google and Tesla stated in their earnings reports that they had seen increased CapEx spending on data center buildouts. So that money is going somewhere. It's not being lit on fire, it's not being thrown in a ditch, right? There are winners to this, and the winners are Micron, SK Hynix, SanDisk, and others. All these companies that I mentioned in my latest video, if you haven't seen it already, check that out. Anyways, so if you find this kind of content interesting, valuable, and you want to stay ahead of what's happening on Wall Street, be sure to subscribe and like this video. Thanks.